Awesome. We are now live. Thank you so much for joining. And I guess we'll start with a quick introduction from yourself, Tay.
Yeah, sure. Thanks, Ash. So hi, everybody. My name's Tay Kavanagh, and I'm the Managing Director of CompleteRPI. So welcome to the first of many webinars I hope that we'll be presenting to you. So we're at CompleteRPI, we were always on the lookout, I guess, for partners that will actually make your landlord journey as easy as it possibly can be. And today I'm extremely excited because obviously as a CPA, I would be excited about taxes, but more so as a landlord. I think we found a solution. I think for myself, because I use tax personally, a solution that will make the lodgement of your UK tax returns really easy and cost effective. So I want to introduce you to Arj and Eamon, who are the founders of Tax. What they'll do is they'll take you through the platform. They'll talk you through sort of the costings involved in using their platform and also answer any questions that you might have. So over to you, Arj, Eamon.
Sounds good. Thank you so much, Tay. I guess just as a bit of background to myself, my name's Arj, and I've kind of worked in the tax and technology side of things for the last 6 or 7 years. And we set up Tax to really make tax filing easy for non-resident landlords, specifically because we know a lot about that international tax market, and it's very expensive to file and lodge your taxes, especially as a non-resident, because of those complexities that arise when you declare your residence with HMRC. But we'll show you how easy that is to do. Plus, we'll talk through some cases around tax residence and how you can be more tax efficient with your rental income in the UK. But before we start, I'll just pass over to you, Eamon.
Thanks, Arj. Yeah, so sort of as Arj mentioned there, we're both ex-PwC, so we've worked in this space for many years. My specialty was actually in international tax, specifically with property investors from overseas. So we cover sort of the main cases that you're likely to face, whether that be holding your properties right in a limited company in your name, the most efficient way to sort of extract your rental profits. Of course, there's going to be different situations based on everyone's individual circumstances, but hopefully give a good overview on how to sort of be the most tax efficient with your investing here. And then, as Tay mentioned, actually show you our platform that will help you file your self-assessment. As a lot of you probably know, non-residents and those of you who are obviously based out in Hong Kong can't file through HMRC, so you need to find an alternative solution. So we'll just show you how we link in with HMRC and sort all of your taxes. But I think just before we get into the boring tax stuff, just to lighten the mood, I think we've got a quiz set up by Arj. And just before we jump into that, guys, please fire questions throughout the talk, right? We'd love to make this really interactive as we go through areas. Just fire over questions and we'll answer as we go. And if not, we will also have a Q&A at the end. So if there is a burning question or something you think about, since we've moved on, just put the question forward and we'll make sure we get to it at the end. But thank you.
Awesome. Thanks, Eamon. So hopefully everyone can see my screen on the YouTube kind of broadcast. And what we'll be talking through, I guess, is your kind of resident status, the tax situations. But as Eamon said, we're going to start off with a quick quiz just to understand the sort of tax kind of situation when investing in UK rental properties. And you can join the quiz by scanning the QR code on your phone. So if you've got a phone at sort of arm's reach, or you can also use slido.com and use the hashtag TAXD. And I'll give everyone just a couple seconds to join the quiz. It should give us a bit of information around what type of taxes might need to be paid and things like that. So hopefully it will be a nice way to kick off the presentation. So if you could join the quiz, and then we'll start off with one question as a little warm-up. If you could have one superpower, what would it be? And then you can answer as many times as you like, I think. So not being taxed, so it's not paying tax. Turn back time, that's a good one. Invisible to tax authorities, that's that would be great. to teleport. That I'd certainly love to be able to teleport. That would avoid all the flying around and having to actually travel. No need to do TAC filing, seeing the future.
I don't think it's a surprise that there's a massive correlation here around not paying tax and avoiding tax.
That's good. That one's quite a couple on the not paying tax one. All right, well, that's good. So we can see that we've joined. Let's start the quiz itself. So now you can use your name or a username, and we'll work with Tay as well to send out a prize to the winners of this quiz at the end. And once we join the quiz, we should be able to then start off with some of the answers. Lovely stuff. So I think you still have some time to join the quiz, but I'll just move into the first question now. So as a non-UK tax resident, so if you're living abroad and you don't qualify for UK tax residence, what would you be taxed on? Is it UK sourced income? Is it worldwide income? Is it UK sourced capital gains or worldwide capital gains? And you can choose multiple answers here, and that might be a bit of a hint, but see which answers we can get. Now, this is who wants to be a millionaire? Who wants to be a tax millionaire? Taxed version. So we've got 5 of 7 answers so far. Let's see what we get. We'll just give everyone a couple more seconds for the final couple answers. Now we'll spend a bit of time as well sort of talking about tax residence and how it works, especially if you're living abroad and what could qualify you to be a UK tax resident. In this case, as a non-UK tax resident, you would only be taxed on UK sourced income and UK sourced capital gains, which is quite a good thing, I guess, so that any income that you make from abroad, from Hong Kong, from other parts of the world will not be taxed in the UK. The UK will only tax income or gains that have been made or sourced in the UK. Things like your rental income in the UK, or if you sell a property in the UK, that could be subject to capital gains. Now, the tax-free personal allowance, this is quite an interesting one. And do you have a UK tax-free personal allowance of £12,570 if you are a UK tax resident, if you are a British national, if you have a British overseas national visa, or if you're a Hong Kong tax resident? So this is quite helpful where in some cases you may earn your rental income in your personal name, and you may want to use up your personal allowance if you're applicable or if you qualify for that. Now, we do get a lot of questions whether things like a B&O visa will qualify you for that personal allowance, but hopefully this quiz question, we'll see the answers and we'll see what we get. We'll just give everyone another couple seconds. You can tick more than one answer on this as well. Again, that might be a little bit of a hint. And let's see. Awesome. So the only cases where you would get your personal allowance in this example is if you were a UK tax resident or if you were a British national. Now, like a B&O visa, although it's a British overseas national visa, it does not qualify for the personal allowance according to HMRC. So it's slightly different there, and something that we see a lot of clients sometimes think that they get the personal allowance, but they do not. Now, quite an easy one, I guess. Do you need to file a tax return if you're renting out UK property? Yes, I need to file, or no, tax is automatically taken off. Now, in some cases, tax might automatically be taken off, but we'll explore that in a second as well. We'll just give everyone a couple more seconds on this one, and we'll show you the easiest way to file your tax return within a couple minutes in a few seconds. And if you hold a British passport, then you would be classed as a British national. So then you would still qualify for the tax-free personal allowance. So that can be quite useful when renting out property in your personal name. Awesome. We've got 100% on the yes, I need to file. So that is good. And we can certainly show you how to make that super easy. Now, declaring your tax residence. This is quite an interesting one, and I guess this is where some of that complexity occurs when filing your taxes in the UK. And would you need to declare your tax residence with the SA 109 form? And a couple of the answers, yes, and it needs to be on paper by 31st of October. Yes, you can file by paper by 31st of October or online by 31 Jan, or no, you don't need to declare your residence. And we've certainly seen individuals across the world really that file their tax returns in the UK that may not include those pages, but it may lead to a lot of HMRC questions as time goes on. And let's see what answers we get for this one. And awesome. So you can file by paper by the 31st of October, but you can also file online by 31 Jan. I think that's a misconception that we get quite a lot, is that you need to file by the 31st of October because you're filing the SA 109 pages. And by using software, you can file online, which gives you those extra couple months to get your rental income expenses and so on together so that you can file online and you don't need to be posting tax returns with paper letters and stuff the old school way. I think this is the final question. Is UK tax automatically deducted from my rental income? Either yes, tax is always deducted, yes, unless you file the NRL1 form, which we'll talk a bit about, or no, tax is never taken off. And for many of you, you may have already sort of seen this process or had tax taken off and had to file some forms. But it's a good understanding, I guess, where in the UK, how rental income works specifically for non-resident landlords, as it is different if you were living in the UK. So let's check out the answers on this one. Yes, unless you file the NRL1 form, which means that in most cases, if you're a non-resident landlord, your kind of agent or the management agent will automatically take tax off your income unless you file the non-resident landlord form with HMRC. And that basically tells HMRC that you don't want tax to be taken off. And that's quite helpful because in many cases that tax is taken off without looking at expenses or looking at the total picture of your rental income and your rental profits. Awesome. So that's the leaderboard. So congratulations to you, Jen. That's awesome. You got all 5 correct at the quickest time as well, 2 minutes 27. Lovely. So now we'll move on to the tax part of the webinar, UK tax as a non-resident. So for this, I'll pass over to my colleague Eamon.
Thanks, Arj. Yeah, so I think a good place to start really is around the resident section, as obviously the majority of you guys are based out in Hong Kong. I think often a lot of talk is around the UK taxes on the rental income, and then not so much on understanding the residence and how ultimately you could trigger residence based on traveling to the UK, the day limits you need to sort of stay under to remain as a non-resident. Or if you're frequently in between UK and Hong Kong, how that may obviously affect your taxes. So I'm not going to spend a lot of time on it, but I think it's a good introduction into sort of UK tax. So as you probably saw from the quiz there, as a non-resident, you'd only be taxed on your UK income and gains. Now, to qualify as a UK non-resident, there are certain rules you need to meet. And the sort of 3 listed there on the slide, these are known as the automatic non-residence test. So if you meet any of these conditions, you'll automatically be considered as a UK non-resident. So first thing we do is we look at the 3 previous tax years. So you'd look back 3 years before the tax year you're filing. And if you were a non-resident for all of those 3 years and you were present in the UK for less than 46 days in the tax year, then you would be considered automatically as a non-resident. The second condition, the only slight difference is if you were resident in at least one of the previous 3 tax years, then the 46 days is reduced to 16 days. Now, often those are the most common we see with investors out in Asia. A lot of people just, I don't really blame them, don't want to come to the UK that often. So they've got the property, but they're well within those days. Sometimes just no days in the UK is what we see. But for sort of your own awareness, it's good just to know those two tests. Now, the third test is if you guys are working full-time overseas. So if you're in full-time employment in Hong Kong with a Hong Kong employer, then you're allowed a few more days into the UK. So you can come into the UK for up to 90 days. And of those 90 days, 30 of those can be for work purposes. Now, a work day in the UK is considered 3 hours or more for your employment overseas. Now, the only thing that's worth noting on this condition is that any sustained period of time in the UK over 31 days at one time will break this rule. So you've got the 90 days into the UK and the 30 work days, but not coming into the UK for more than 31 days at a time. If you meet any of those conditions, then you're automatically non-resident, and then you do not need to report any income or gains or interest, dividends, whether it be from crypto, etc., on your UK return. The only information HMRC need to know about is the UK income, and that's all you'll be taxed on as well. Now, the only slight addition to this is if you don't happen to meet any of those rules, let's say you were in the UK for 94 days, for example, then there's something known as a sufficient ties test. Won't go into that right now, but essentially it's a match between how many days you've done in the UK and how many ties you have to the UK. Ties could be things such as UK resident family. And then based on the number of ties you've got and days, you'd be considered a resident or a non-resident. But I think for the purpose of this this sort of webinar, the majority of you guys would fall under the 3 conditions. Now, if you are a non-resident and you've got UK income, you would need to report this on your tax return. So we're going to show you a demo shortly around how you do this. But essentially, when you've got a UK self-assessment, you add multiple supplementary pages to the return. So they've each section's got different codes, such as SA105, SA108, SA109. The supplementary page for residents is known as SA109. So this would be added on to your return. And the key bits of information you'd need to give as a non-resident is the days and work days you spent in the UK, your nationality, where you were resident, and the condition you fall under non-resident. So hopefully a straightforward one there for non-res. If we could just jump to the next part, Arj. And this, just wanted to briefly mention this, as I've recently been dealing with a few clients from Hong Kong who have been moving in and out of the UK. So I thought it'd be good to touch base on split year treatment. So split year treatment, as it's sort of mentioned in the name, as you can imagine, is where you would be treated as a UK resident for one part of the tax year and a non-UK resident for another part of the tax year. So if you are moving between UK and Hong Kong during a tax year, then as you can see there would be different conditions based on whether you're leaving the UK to return to Hong Kong or you're moving to the UK from Hong Kong. Now, typically, if you're leaving the UK, it's pretty straightforward that you would be starting work overseas, you're the partner of someone starting work overseas, or you no longer have a UK home. Now, it's important to note for residence purposes, ceasing to have a UK home doesn't mean that you don't own UK property. It just means that it's not left empty for you to come in and out of whenever you arrive and sort of live in the property. And if you're moving into the UK, it could be starting to have a UK home, starting full-time work in the UK, or being the partner of someone who works in the UK. So typically what you would see is you would be considered a non-UK resident. So if you're moving into the UK from Hong Kong, you'd be seen as a non-UK resident up to your point of arrival. And then from your arrival into the UK onwards, you would be taxed as a UK resident, and therefore on all of your income. And obviously it's just vice versa for leaving the UK. So I guess one thing I would say is if anyone is coming into the UK from Hong Kong, any income or gains or savings that you've made whilst being out in Hong Kong can be labeled as pre-arrival capital, and therefore not subject to any tax from HMRC if you were to move any of that money into the UK. It's just worth noting that if you do move into the UK, to create a new account to separate any income after that point. So perfect. Yeah, that just sort of covered the split year. Jump to the next slide, please, Arj. Boom. Perfect. So as mentioned there, hopefully that's just cleared up the residence quickly for you guys. Happy to answer any questions on that at the end if there are any. But assuming most of you guys in Hong Kong are non-residents because you're living and working out there, then you will be taxed just on your UK sourced income. UK sourced income can be narrowed down in these situations, looking at property, to obviously your property rental profits, your property gains, and income in a limited company. Now we'll break down what actually makes up your property profits, but as you can imagine, it's just your income minus your expenses. The gains is if you obviously sell any of your UK property, and then similarly the same apply to if you're holding property within a limited company. Some of you guys potentially may also have bonds or savings accounts in the UK which could be paying interest. That would obviously be taxable as well. And one thing to note, which we'll go into shortly, is if you are a non-resident, if you're taking dividends from your UK company, they would not be subject to UK tax in the time of question, being a non-resident. But this is the main area of income that you'd have to report on your return. So as mentioned, your Hong Kong salaries, any profits from businesses overseas, any investments, wherever it be across the world, wouldn't be reported or subject to any UK tax. Perfect. So from that point, and just before we get into the demo on how to actually, report your property profit and your resident status, often get a lot of questions around this topic in terms of what is a income expense and what is a capital expense. So as you probably know, it's normally preferred to get something as an income expense, therefore it's deducted off your rental income. It saves you tax now rather than in the future when you may sell the home. It's also typically if you've reached a 40-45% tax rates, there's a better tax saving than the maximum CGT of 28%. Now, the rule around rental and capital, it's always, I guess, up for question, but as a rule of thumb, the expense has to be wholly and exclusively used for the property business. Now, a rental expense, also known as an income expense, so this is expenses that will reduce your profit that you report on a self-assessment, could be things such as replacement of white goods or furniture, repairs and redecoration. So on those 2 points, typically, right, what we might see is clients who want to make a completely fresh upgrade to their home because potentially they can get more rental income from that, or it may help with the advertising and so on. In terms of HMRC's rulebook, redecoration and sort of the replacement of white goods, it's basically keeping it to a rentable standard, right? So if, for example, you already had your washing machine in there and the tenant broke this, then obviously the replacement of that washing machine would be an expense straight away. However, if the washing machine was working and you upgraded this to a newer version, etc., that wouldn't be considered as a rental deductible expense because there was already one there working. So HMRC look at rental as expenses that are necessary to keep the property on rent. So similarly, that could be that you are replacing carpets because there's been a stain from previous tenants, not because you want to change the color from cream to gray, for example. That would come down as a capital expense. So that sort of redecoration, renovation costs, which are necessary for the rental section, can be used. Of course, all sort of accountancy, legal and estate agency fees, property management fees, etc., all 100% deductible on the return, as well as advertising and insurance costs. So you guys probably got your landlord insurance, your home goods, content insurance, etc., all deductible, and then any advertising. So again, advertising usually links in with the estate agent or the property manager. Now, the final thing would be any interest and finance costs, and we will touch on this. I'm sure you guys are all really aware of rules that have changed over the last few years. But now what you do is you get a 20% income tax deduction of your finance costs. So easy numbers, if you spent £10,000 a year on mortgage interest, then rather than deducting the rental, deducting that from the rental income, you would do the rental profit calculation first. Let's say you had your income and you took away your expenses and you made £10,000 profit. Then at that point, the tax is calculated on that 10,000. Again, let's just say easy numbers, 20%, that's 2,000. And now at that point, we look at the mortgage interest. So we see, okay, your mortgage interest was 10,000. You get a 20% income tax deduction. You would get a £2,000 interest deduction off your 2K bill, and it would net to nil. Obviously, if you are in a 20% bracket, then there's no cost to you. It's great. It doesn't make a difference whether it's expensed at the start or as an income tax deduction. But if your rental profits take you into the 40% band, now you're losing the efficiency, right? Because rather than getting a deduction at 40%, you're having to wait and get the 20% off your income tax. So there's a 20% cost to you. So that's hopefully covers a few of the expenses, and we will dive into it in a second. Just from a capital perspective, really quickly, sorry, Arj, is essentially, as you can imagine, any improvements to the property. So HMRC sort of describe it as expenditure on a property that leads to improvement. So I've just given some examples, as you can imagine: extensions, renovations such as garage conversions, window replacements if they're obviously in fine condition, and it could be replacing driveways, doing gardening, doing landscaping, etc. All of that sort of thing is going to be deducted when you sell the property rather than renting the property out. So it's really important, I think, for all of you to really consider what you're going to be spending on a property in terms of renovating, because so many clients think that it's instantly all going to be deducted for tax right away. But sometimes part of it can be deducted now, and a large portion you have to wait until you sell the home. So if there's a long-term plan with the property, it's often worth planning that if you're going to make these improvements from a tax perspective, that you might have a delay on any of the sort of deductions. So it's just being aware before you pull the trigger and give your new tenant, I don't know, a cinema room in the garage or something like that. So yeah, perfect. So that just sort of covered the residents and working out what's deductible and not. And now Arj will actually put it all into play now and actually show a situation where you can prep your return using tax. So over to you, Arj. Cheers.
Awesome. Thank you, Eamon. So now we'll take you through the platform that we have created, and it's really been developed to make tax filing super easy, specifically for non-residents. So I'll just do a brief sort of run through. Taxed.co.uk, and then you can hit the start for free button when you're ready. And the way that Taxed is built is it's almost like having a conversation with your accountant, perhaps even more fun because you get to click little buttons and then it takes you through your actual tax return, and then you can submit it straight off to HMRC. So in this case, we're filing a personal tax return. I'm going to be an individual from Hong Kong that has invested in some UK property, and that's the tax return that I will be showing you today. But we cover a whole range of tax situations. And in this case, I would just need to select that I'm a resident of another country. Now, what we're doing here is we are trying to build your personal experience. So if you select that you were a resident of another country, then we know that we need to include questions around that SA 109 tax form, around your residence, around your work days in the UK, and so on. And in this case, we'll just select that we were a landlord. We see if we had a limited company that was running some of the properties as well, we could select that. In this case, we'll just select landlord and rental income, and then we should be good to go. And if we've sold any assets here, we can also start to declare those capital gains on UK properties within our self-assessment tax return too. And then we're ready to create our account. Now, what I'm going to do is I'm just going to switch into an account that I've already made, and then I can show you what the tax return actually looks like. So we've just completed our introductory questions, and then we need to complete some questions around our tax residence. And this relates to the tax residency rules, which we were talking about a couple seconds ago, and around those automatic non-residence tests. Now, in many cases, you may qualify for automatic non-residence because of the amount of days that you spend in the UK would be minimal. And I guess that's the case that we see for a lot of non-resident landlords. So it's quite a simple situation where there's not been many days in the UK. So it's something that we can automatically create those residence tax forms within a couple of seconds. So how many days in the UK? In this case, we'll just put 15 days in the UK and 0 days spent working, and then 0 to exceptional circumstances. Now, each question that we ask you here, there's a lot of logic applied to each question so that we ensure that we ask you the relevant questions afterwards and ensure that you don't need to answer questions that are not relevant to your specific case, making it super easy to go through and click exactly what relates to your particular tax return. And in this case, we are a national of Hong Kong and tax resident in Hong Kong as well. Now, in cases like we had a question before, you could have a British passport, so be a British national. And essentially what this will do is this will apply the sort of tax-free allowance if you are a British national. So what we can see here, throughout our tax return, we can see a tax position of what our tax return looks like. So it's also great if you would like to model your tax return and see how much you could save by investing in certain expenses and so on. We can see in this case, as I selected that I'm a British national, I get my full tax-free personal allowance. However, if I switch that back to Hong Kong, I can see that I no longer get that tax-free personal allowance. So there is a bit of a tax liability there. So that's essentially how our tax residence pages work. We ask you questions in a super simple format without any tax kind of jargon to complete the SA 109 forms that we'll then send off to HMRC. And it literally only takes a minute or two to get those residence pages completed. But we'll now look at the more interesting bit, the rental income, and see what we can expense and how rental income works. So in this case, what we'll do is we'll just go into rental income and we'll hit amend, and we can see that we can add in multiple properties. So if it's one property or 10 properties, you can add them in as single kind of properties, or you can kind of group them into one, whichever is easiest for you as you file. And in a similar way, we'll then ask you questions in a simple format, which is easy to understand. So whether you've got a residential property or a furnished holiday letting, we'll take you through the process and apply the relevant rules relating to that type of property. So I'm going to add in my address of the property, 10 Downing Street, and then we'll move on to the next questions. And many of you may own a property with a partner, and in these cases, we have to declare that on the tax return in a separate way. In the UK, there's not a concept of sort of joint filing. So as individuals, you may need to file separately, but you would mark your property as being owned jointly on your tax return. And then we ask questions around tax being deducted. So as we mentioned in the quiz, in many cases for non-resident landlords, tax will automatically be deducted, but this doesn't look into expenses. So this can often lead to a tax refund being due. And if that's the case, we can just input the amount of tax that was deducted. In my case, that's going to be £3,000 because we've got rental revenue of £15,000. So around 20% of tax has already been deducted from source. And this then leads us to the questions around expenses. Now, as Eamon mentioned, there's often questions around what can be expensed on your rental income to lower your rental profits and therefore lower your UK tax bill. And what we do is we will suggest to you the relevant expenses that relate to your specific kind of property. So if it's a residential property, we will then ask you about things like your mortgage interest, your mortgage arrangement fees, management fees, accounting, insurance, redecoration costs, and so on. There is a whole host of expenses that can be claimed, and we'll ensure that we cover every single one of those to make sure that you maximize your tax efficiency when filing with HMRC. And in this case, what we've done, we've just kind of preloaded a couple of examples that we see that are very common, things like interest, accounting fees, management fees. And then with kind of recent changes and things like that, you may need to get like a gas safety certificate, things like that, to ensure that this kind of property from a tax perspective is being as efficient as possible. Now, what this does is it also then updates your tax position. So as you add in expenses, you can start to see that your refund or your refund may increase, or your tax bill will start to go down as well. So it gives a live update kind of based on the inputs on the tax return. And we are working on making this as seamless as possible. So looking at kind of integrating with partners such as Complete RPI to ensure that all the information can come straight through into text, to make the actual tax return process super easy so that there's not much for you to input. And then we've got questions around sort of driving to and from the property or using the property for personal use. And then that's it. That is the property section complete. There's just a few additional questions around if you expect your property income to continue next year. And that just impacts things like a payment on account if you need to make payments for future years. And that's it. That's all the questions that you would probably need to answer for your tax return. We do have additional questions for completeness. For example, if you've had to make payments on account for previous years, we can then add that into this tax return to then ensure that that's being taken care of and your refund being calculated appropriately. But we'll then just take you through things like your personal info, which is just like your name, your date of birth, address, and so on. And then once that's all complete, we then unlock the finalizing your tax return section. Now, I've already hit the submit button on this tax return, but this will look slightly different if you hadn't submitted. But essentially what we have here is if you have a refund due, you can get that paid into a UK bank account, or if you do not have a UK bank account or would like it sent by check, you can leave this blank and then HMRC will send a check by post. And that can also be sorted. Now, this is where there is a payment here, and we charge a £90 fee for filing a tax return. And this fee is collected at this point. So you can get through the entire tax return and you only pay when you're ready to file the tax return to HMRC. And then we also show you the full tax calculation. So looking at the total property turnover and then allowable expenses. And then you can start to see how your tax was calculated in the UK. So you can see that we apply the 20% tax rate to the rental profits, which gives us the tax bill of 1,950. And we've also got the relief for finance costs. So we handle all the calculations in terms of mortgage interest and finance costs. That is done automatically on the taxed side of things, and that prepares the relevant tax return for you. So in this case, no other information needs to be submitted to HMRC. Verify your identity with a passport or driving license or any form of ID for our anti-money laundering purposes. And then that's it. We're ready to submit. So once I hit the submit button, It takes a couple seconds, but essentially we have integrated with HMRC as a recognized software supplier. So the tax return can go instantly off to HMRC. There's no sort of paper forms. There's nothing that needs to be downloaded and then printed and then sent off manually. Everything is done within seconds, and then that's been filed. Now, I'll just show you the final bit. Now that we've filed our tax return, it's been sent off. We can now then see a few files for our own records. So we can go back in and make any amendments to our tax return if we need to. And you can amend a tax return for 12 months after the filing deadline. So for the 2022-23 tax year, the filing deadline is 31 Jan 2024, but you can make any amendments to that tax return till 31 Jan 2025, which might be helpful if there are any expenses that you may have missed out or anything else that needs to be declared. Now, in this case here, we've also got two files, an SA302, which is a tax calculation, and SA100, which is the actual tax return itself. So we'll just take a look at that real quick. And I can see here, this is my tax calculation summary. And this is great just for your own records. It's just a copy of that document, of that calculation that we showed you a second ago in terms of how we calculated your taxes. And that's that one. And then the final document that I'll show you today is the SA100. So this is your actual tax return itself. So this just kind of showcases that HMRC has accepted your tax return. HMRC used these reference numbers as a way to check the specific kind of filing, when it was filed and what was filed. So it's good to keep this for your own records. And then you can see the tax return itself in a PDF format. So that's the end-to-end tax process, and happy to answer any questions. So feel free to shoot that into the chat. But in the meantime as well, we'll then jump back onto the slides and talk through a couple other bits around your tax position, around setting up a limited company, and so on. So I'll pass over to Eamon. We've just got a couple questions here, so I'll just answer these now. So this is £90 per person at the moment, and we do offer sort of discounts per kind of household. We're kind of building technology at the moment which will allow you to have one account per household, but then the ability to file for multiple individuals within that household. So that's coming out in the next couple of months. What is the process similar for filing tax for property under joint ownership? Me and my spouse, can we do it once, or is it separate filing? So that would be separate filings. However, you would declare that the property was under joint ownership. So you would both need to file a separate UK self-assessment tax return, but you would report your income or your part of the income on that tax return. Hopefully that helps to answer those questions. And then we'll just go into limited companies as well now. So I'll pass back over to you.
Perfect. Thanks, Sarge. Also noticed as well, there was one question there around sort of moving property into a partnership. So just before we jump onto LTD, so obviously traditionally, right, as you move a property over to a business, you technically have to report this at fair value. Fair value, you can typically make it obviously less than what would be going on the market rate, but it's close enough. So as you'd probably know, that would then essentially have a second consequence with stamp duty, land tax again, and also capital gains, because you are unrelated essentially to the business. A company is seen as a completely separate entity. So that company buying the property is essentially a new owner, even if you are the director. Some people like to look at partnerships because essentially with a partnership, you're just selling it to yourself. You're still the owner, the connected person. So you can, it still is being sold to a partnership, but the rules are slightly different because you could essentially determine what you might make as the value. So you could use it as income the property brings in. You could just basically set the rate you want to pay for the property and therefore reduce the cost. There's obviously a lot more admin around that. And also obviously with a partnership, you have to declare the profits of the partnership, I guess, as sort of self-employed income. So at the usual 40, 45 income tax rates. So it's a tough one. Most people we deal with typically go into LTDs, but we can reach out to you, Andy, separately on that if it's something you'd like to explore in terms of moving it to a partnership. But right now, I think the most common structure we're seeing at the moment is limited companies. And I just wanted to go over the sort of pros, the cons, what you need to be thinking about when looking at your properties you hold and how to structure them. There's such a range of different structures out there, as we've just mentioned one or two of them. There's all sorts going on, but I think at the end of the day, every person has a unique situation, and that's really important to look at. The first thing you need to understand is what your goal is with your properties. What are you doing with them? Are these properties ones that you look to flip within a couple of years? Are these properties ones that you're going to keep for generations? Is this a 20-year hold? What is your goals in terms of the portfolio? Are you looking to increase your portfolio and get more properties? Do you want just a couple to supplement your current income, and so on, right? So there's so many questions that we would have a chat, we would discuss if you need sort of separate support on this area of things to actually determine what's the best solution for you guys. But in terms of some rule of thumbs, where we typically see people move into limited company or set one up or start to look to have changes, as you can imagine, it's when the tax rate changes in your personal name from that 20 to 40%. So if we use an example, obviously, for someone from Hong Kong who doesn't have a British passport, so they're not receiving the personal allowance, any rental profit over 37,500 is going to move into that 40% tax bracket, right? So at that point, it may become more suitable to look into a business. So I guess from a business perspective, right, as I'm sure you guys are aware, a lot of the main benefits come from the financing and the interest in terms of being able to get a full deduction on any finance cost or mortgage interest you're paying. Now, obviously, if you're a cash buyer, that benefit doesn't exist for you because you've not got finance costs, right? So another thing to consider. But if your profits are quite high, over for 37,000 a year, then you may benefit from the lower corporate tax rates. Now, traditionally, obviously, as you probably know, it's been 19%, and then the great UK government have increased that now ever so slightly. So how the corporate tax works now, you got 19% up to £50,000 of profit. Then you have like a scaling system between 50k and 250k, and then any profit at 250k or more is a 25% corporate tax rate. Now, the reason that's important is because obviously it's a lot lower than the 40% and 45% income tax rates that you would start to pay if you just held the property through your name. So you get that instant tax saving there. And as I mentioned earlier on this sort of webinar, dividends, which you pay yourself through the business, would essentially be known as something called disregarded income. So if you are a limited company owner and you pay yourself dividends from this business, they will not be subject to any form of income tax here in the UK. So traditionally, right, if I was to own from my UK limited company, if I pay myself £10,000 of dividends, I have to report that on my self-assessment. I have to pay tax at the dividend rates, which is 8.75 up to 38 plus. Now, if you are a non-resident, you essentially disregard that income. You don't have to pay any taxes on those dividends, with the one caveat being that you can't become a resident in the UK within 5 years of those dividends payments. Now, it's known as temporary non-residence rules. So what they're trying to do is stop people like myself moving out of the UK today, breaking my residence, making big sales, paying huge dividends to myself, and then going back in a few months' time. So they've put this sort of 5-year rule. But if you are residing in Hong Kong and living there and looking to stay there for the foreseeable future, then your dividends essentially would continue to come tax-free. And it's just being aware that if you wanted to migrate and go over to the UK, then you would look back 5 years, and then those dividends would come and under sort of taxation. But initially, the beauty is that you get the lower corporate tax rate, and then all your profits can be sent to you as dividends without tax right now today. Obviously as well, if you're looking to expand your portfolio, the lower CGT just gives you more money within the business to reinvest and acquire more properties, and therefore grow your portfolio a lot quicker. Now, there's cons of running a company as well. There's a lot more admin and management, which hopefully we're going to look to make that a lot easier for you guys. But you would have to complete annual company accounts and corporation tax returns. You'd need to complete annual sort of confirmation statements, just to give some details of the business. And then I guess one point as well to mention is if you're buying high value property, so high value property is 500k or plus in the UK, then you've got something known as ATED, so annual tax of envelope dwellings, which is essentially an additional tax charge for any property you hold within a business that is worth 500k or more. And again, it's done on a scaling basis based on the value, and it's an additional charge you'd have to pay with your corporation tax each year. So again, this is why it always comes down to planning, because you might put a section of your portfolio into a company. You may keep one or two in your name because you might save charges, for example, on a property in your name, and you may want to have a small amount of income in the UK at the 20% rate. So it always just comes down to overall planning and understanding what your portfolio is and what your long-term goals are. But typically, a rule of thumb, if you are looking to have expand your portfolio and have in normally what we see sort of 3 properties plus, then you would start to look at an LTD. You would typically start to see your profits go from the 3 properties slowly go above the basic rate in the UK, and it's quicker to expand. And I think as well, it's sort of going back to a question from you guys in terms of moving property over. You may also want to buy a property in a business now. Yes, you might not really reap the rewards in the next 24 months, but if you have the understanding that you're going to be buying more over the next few years, then you've already got that structure in place. So then you don't end up in a situation where you're trying to restructure and come up with costs, etc. So typically the pros, as mentioned, is through a company. Another sort of tip on that as well is if inheritance tax usually comes up a lot, and passing businesses down. Now, if a company holds properties, right, that are traditional buy-to-lets, they rent at, you got a long-term contract, 1,500 a month, etc., then these are seen as investment vehicles rather than sort of active companies. So investment vehicles, you've probably heard of SPV, special purpose vehicle, which is often thrown around with property. These are essentially subject to traditional inheritance tax. So if your children were to inherit these businesses, they would have to sort of pay the usual rates and allowances as if it was in your name. Now, to mitigate that, you've probably heard of sort of the 7-year rule. So if you transfer an asset over to a family member, children, etc., and you live for a further 7 years, then that asset has gone into their name, and there will not be any charges. And if you were to pass within the 7 years, it's done on a scaling business. Now, another route in terms of properties to look at the inheritance tax is if you were to move into a more short-term letting offering as well. So it may not be done now, it may be something you want to do right in the future. But if you move into something known as furnished holiday accommodations or short letting, now this is seen as a trading business. Now a trading business essentially can get business asset disposal relief, right? So the business would then be inherited tax-free, provided that has been the main activity of the company for 2 years, right? So you may decide, later on that actually I've got 20 or 10 or 5, whatever properties in the business. And towards it later on in life, there's options to change the activities of the business or make the transfer. So you get a little bit more flexibility as well in a company in terms of structuring. Again, it could be putting shares of the business into, kids or family name earlier, but you keeping control and running of the business, but then you're slowly putting shares into their name rather than transferring properties, etc. So it's got a percent of an entire portfolio. So so a lot of pros and cons there. Again, I wish I could sit here and just tell you right now, set up a business tomorrow and buy your property through that, job done. It's obviously going to take a little bit more to it. But yeah, typically the rules of thumb are looking at the plan you've got going forward, number of properties, your income levels, and if you have mortgage financing, because that's where sort of the main benefits come in. Perfect. Just jump on to the next one. Perfect. And then another topic, obviously, is the CGT in terms of selling properties. So if you're non-resident, as we sort of discussed earlier in the webinar, then you're only taxed on UK income and gains. So it would be UK assets, which, as you can imagine, is pretty much always land and property. Now, the CGT rates are 18 and 28% for property. 18% is if you are basically have that basic rate band, that 37,000 spare from, so you're not getting income in that rate. So what we typically see is 28% is the main rate of tax, and is the rule of thumb you guys should be looking at in terms of tax on your profits. Now, as you can imagine, this sort of leads back to what we spoke about earlier in terms of rental versus capital expenses. Any expenses you pay that didn't qualify for rental deduction, so it could have been that garage conversion, whatever it was, in terms of upgrading or improving the property, can all be now expensed here against any potential gain. So as you can imagine, a very simple CGT calculation. In terms of your proceeds, take away your acquisition costs, all that spend between the time of owning the property in terms of improvements and any sales costs in terms of your usual fees and with solicitors and agency. Now, couple of points on this as well is, if you ever lived in the property at any point, let's say you lived in the UK for a period of time and you lived in that home, then you may be subject to something known as private resident relief. So that essentially means that some of your gain will be exempt from tax, because part of the period of ownership of that home, you yourself lived in it. An easy rule of thumb is that you always get a sort of first year and final 9 months of ownership of a property that automatically get taken off again. So again, probably not relevant for most of you based out in Hong Kong who are investing from overseas, but just something to be aware of if you're buying, or if you've had a home that you lived in previously and you've since gone back to Hong Kong, that would get further sort of reliefs. In terms of filing, if we jump onto the next slide, Arj, the dates for a capital gains returns, you can see there, you'd have to report that sale within 60 days of closing. And that's where you would go over what we discussed in terms of all the costs and reporting your overall gain. For non-residents, you need to report the gain even if it's a loss or you didn't make any money, you still need to report through a CGT return. So I think that's something to be aware of. A lot of people have a misconception that if they've made a loss, they don't need to report anything to HMRC. Whether it's a loss or a gain, you'd still need to report that property sale to them. Now, on the topic of dates and deadlines, just put together a few key ones here, which probably important to add to your diary. As Arj mentioned earlier, the online tax filing for self-assessment, if you're obviously needing to report your SA 109 and your rental income, is the 31st of January following the end of the tax year. So obviously right now there's plenty of time to go, as the tax year's just ended on the 5th of April last month. What we often find though is a lot of people like to file earlier just to understand what their bill is going to be, and then wait until the 31st of January to actually hand it over to HMRC. But it's good just to plan ahead. If you are to make payments on account, now typically this wouldn't apply if you're non-resident with property income, because that would potentially be claimed by the agent. But if there were payments on account, then you would have a 31st of Jan and 31st of July payment for these as well. On the point of non-resident sort of landlord tax, so as Arj mentioned, a lot of agencies may withhold 20% usually of your gross income when it comes to rental income from UK property. And then when you file your tax return, you would obviously report the tax that was paid, and that would either reduce your liability or completely cover it and get you in a refund position. If you know that you are not ever really going to make much profit, or the 20% is way too high, because once you file your self-assessment, your bill is really low, then you can claim to have this non-resident landlord tax removed, and you would complete a NRL1 form, which is a simple form within Gov UK that would go to HMRC and inform them. Now, if you've gone down the sort of limited company route, you obviously, as I mentioned, would have to complete the company accounts, the corporate tax return, and the confirmation statement. So company accounts and CT return is always due within 9 months and a day after the end of the accounting period. So obviously no fixed date here. It always comes down to when you set up your company, when the accounting period ends. This can also be changed by the director if they see fit. So it's just worth keeping on top of that and knowing the dates. And then the annual statement is typically every 12 months from when you incorporated, if you're not making changes sort of mid-year and having to update it. But it's a sort of simple statement where you would, it's in the name, you sort of confirm to HMRC that details are the same, or if they've changed in terms of directors, shareholders, and so on. So that sort of covers the dates and the deadlines, and a little bit around the sort of property income and what to report and whether to set up. So I think now would be a good time really just to ask the floor if there's any questions from you guys. If there was anything around the demo Arj gave around the platform, how that links in with HMRC and the filing, or anything from a tax perspective with owning the property. But if not, I do believe this has been recorded as well and will be sent around via a link. And also do feel free as well to reach out to us via email if you'd like to have a more in-depth chat. But yeah, for now, if there were any questions, that'd be great to go through them.
Nice. Awesome. Thanks, Eamon. I guess just the first question around the sort of presentation deck, and as Eamon mentioned, this is being recorded, so we'll share around the link so you've got access to the deck and materials afterwards. So yeah, you can use that. How many individuals can be allowed in one household account? So we currently, the household account is being created, should be released hopefully by October this year. And there's no limit to individuals that can be on one household account. And then, so we don't need to file SA 109 anymore under when we choose to use Taxed. Now, Taxed will automatically prepare the SA 109 pages and file those with HMRC online. So no sort of printing of the SA 109 pages and completing them yourselves, or no large emails exchanges with often expensive accountants that would then prepare you that document to send off to HMRC. This is completed online, and we would prepare the SA 109 on your behalf. Now, just so that I can show you this, this is essentially in that example that we created, this is what it would look like. So we've got the SA 109 page around residence and remittance basis. And then in our case, it was quite a simple example of not being a tax resident, and we only spent 15 days in the UK. Now, this is just a PDF kind of copy, but what we do is we send this in a digital format to HMRC automatically. Hopefully that answers that question, and really appreciate you staying for the extra 10 minutes or so. Much appreciated. But I think that covers all the questions that we've got so far. If there are any questions, as Eamon mentioned, feel free to reach out via email. We can have a more sort of detailed discussion if necessary. If not, we'll also send across all the kind of presentation details after the webinar. Cool. No other questions. Thank you so much, everyone, for joining. It's been great to speak to you today. And as always, if you have any questions, feel free to reach out. Thank you very much.